Welcome back to the YouTube video podcast that we put on. My name is Darson Grantham, and I'm a real estate agent and investor here in Des Moines, Iowa. And
Jared Huseman here, president of the Catalyst team, part of KW Commercial Realty. We're a multifamily apartment specialist across the state of Iowa. Our team focuses on.
Cool. In this podcast or this, video blog, what we typically do is we just talk about the real estate market in Des Moines, Iowa, the conversation we have with investors, and usually we have a specific topic of the day. So the specific topic of the day, we're going to do market update, right?
Yep.
We could do a market update every week. I think it's pretty confident that we could find something to talk about that has to do with the market update every week. But we try to not, I don't want to say it's boring because I'm a market data nerd and I always want to know what's going on. So I could talk about it daily, but it's important to talk about other topics. But
I think it's also important because, like we've talked before, the market changes so much on a weekly basis and a daily basis from what we're hearing. But it doesn't always mean everybody wants to hear about it every day.
Right.
Even though we geek out and we love it here. But the real estate typically moves a little slower, especially here in the Midwest markets. Moves a little slower as well. So that's always interesting.
It's funny that you use the word slow and real estate in the same sentence. Right,
well,
it does move slower, but it's jeez.
So the thing about it is interesting though, and maybe we discussed it a couple months ago, and I had a discussion at least twice this week. Is everybody right now it's all over the news? Everybody's calling for a recession. Everybody's looking for a recession. Everybody's trying to call when it's coming, et cetera, et cetera, et cetera. All I'll say is this: this is one of my theories. Is in the past, Iowa, the Midwest, whatever happens on the coast comes to the Midwest, comes to Iowa. It generally takes us, if you look at actually 08, 09, took us about 2 or 3 years before we hit our bottom.
Yep.
All I will say is this. The world has gotten faster than ever with the birthplace of online, Google, YouTube, social media, software utilization. Just everything has gotten faster. We saw it with COVID. So I don't care when the recession happens or what it happens. At the end of the day, my theory is still that whenever recession does happen, we're going to feel it much faster in the Midwest than we did ever before. We're going to probably have a 3 to 6 month maybe window, is my opinion, whenever it does start happening on the coast. Previously, we saw it happen more in like a 2 or 3 year period. I think we're going to see it faster. 6 months might be a little fast. Maybe it is 6, 9 months. I don't know. But either way, we will see it faster in our market than ever before.
What is a recession? Aren't we already in one?
That's true. Well,
that's literally the definition.
It's interesting you say that because if you actually look at stats, you don't know you're in a recession when you're already out of it, right? That's always the joke.
When you're already in it. Well, you may be out of it, but
in or out of it, yeah.
Right. It's a lagging indicator.
Well, so it's funny you say this though too because I was having a discussion just the other day with a broker in the LA market. So this is a multifamily specialist in LA, not even right. Iowa. And I said, hey, every time a recession, what do you see in your market? What do you have happening? And he made a great statement. I totally agree with it. He goes, Jared, everybody's talking about recession right now. He goes, but my deals are still selling.
Yeah.
So he goes, everybody's saying this. It's a big hot point, but he goes, my market's still selling. And I said, at least for me, for multifamily apartments, I said, totally agree. I said, now what we're seeing is maybe the deal might take an extra week longer. Maybe it has 1 less offer or 2 less offers on it, but we're still seeing stuff transact at very similar pricing than what it was selling 6 months to a year ago. It's just slower, but it's not like we're seeing stuff sell. So even if we are in a recession right now, or we're heading that way, we're still seeing stuff move.
Right.
What do you mean?
Right. In the word recession, I just struggle. I listen to it all too. Mm-hmm. I see people say we're in a recession. You have other people that say that we're not even close. Right. I see both. I listen to both sides of it. But there's a recession and then there's an impact.
Mm-hmm.
Right. We can be in a recession and not see a significant impact.
Right.
I think we have our most recent example of this is the 08-09 crash. Right.
Mm-hmm.
And to say that is a normal recession is wrong.
Right.
Right? So, we don't know what it's going to look like. It might just be a slowdown. It doesn't mean everything goes backwards. We've already had a huge stock price drop, right? The real estate market is going to be slower than the stock market. It's just how it works. So, whether it's going to drop or just slow down.
Well, as we're talking here, Darson, it makes me think about something here that someone said to me years ago, which is a recession is when you're out of work, a depression is when I'm out of work, right? So here's what makes me think about this, though. And this was an honest thought. I'd love to get your opinion on it and anybody else out there watching. We define a recession and a depression, right? But that's always defined by people who have jobs. So if you are an entrepreneur, can you have made success in a depression? Yes, you can start business in a depression. You can start business in a recession.
Some of the best ones.
Yeah, and same point, could you start a business when times are thriving and have been the last 10 years? So as we're saying this, do the terms recession and depression really apply to entrepreneurs and business owners?
Well, I think they apply. They change the decisions that you make as a business owner.
Right.
Right. And whether that is expanding during a depression, because that is where good companies take market share,
right,
or is retracting during a recession, which is where big companies lose market share,
right?
And they typically don't give it back. I don't remember who said that. Someone at Keller Williams.
Yeah.
But it made complete sense, and if you look at the history, it's just true. So it does impact. It is something to pay attention to, and to, yes, get a little bit more conservative.
Right.
Like, fine, I understand where that's coming from.
Right.
We've known that for 3 years, though.
Right.
Right. A recession is coming.
Right.
We just don't know when. And the government bails us out, and they might bail us out again.
Right.
Like,
100%.
It's very possible
I've had a banker
that they bail us out again by the end of the year. And we will all laugh and say, oh, a recession's going to come in 2023. And it might.
Well, you know what the funny part about it is as you say that, I mean, I had a lender say the same thing during COVID. He goes, look, the government came in and bailed everybody else out. And now they're talking about student loan forgiveness here in the fall. And coincidentally, they're, of course, prepping that to be more in the fall, summer months now, prior to an election midterm, as opposed to being released now. I wonder why that's being done. But at the end of the day, you can say what you want, politics does drive some of the economy. And like you said, they might bail us out. And now we're going to be calling for a recession in 2023, 2024. At some point, you feel a little bit like Chicken Little, calling the sky's going to fall, the sky's going to fall. Well, and eventually, you're going to get it right. But at the end of the day, again, I love what you just said, though, is you use these as a way to better make decisions, but at the end of the day, it shouldn't really impact your business. If you're running a prudent, smart business.
It's going to impact it, but it's not like, I was looking at statistics, standard deviation, right? It's not going to be more than one standard deviation, right? I know that's crazy.
I was going to say.
It's like...
well, no, the funny part is I think...
you understand.
But I think I'm rubbing off on Darson here in my standard deviation and bell-shaped statistics.
I took more math than English, I promise.
I love statistics and math and standard deviation, but no, because it describes so much. But anyway, I agree, and I think I really love what you just said about how, I think we should redefine depression and recession for entrepreneurs. I think we should really define that more as how do you make business decisions as opposed to anything else. But at the end of the day, I was having a discussion with one of my potential clients here. This was yesterday, the other day. We were talking about, at the end of the day, good business practices will always win out.
Yeah.
So live off less than what you make. Have reserves and savings. Have good cash flow. And make prudent business decisions. And guess what? Whether it's recession or depression, or it's a great time to be in the market as well and things are thriving, you're going to do okay. So it's funny how that works. Now, the question that you said, I think, is a great point, is in a recession or depression, you should try to take market share and then never give it back. And I think that is the difference between, but that's something you need to make as your own personal choice. Yep. If I own 24 houses free and clear, or I own a 36-unit apartment complex free and clear, and that's all I want, I have no need to grow, then maybe depression means nothing to me. Maybe I just...
Well, it's going to, even then, so think about that. I'll just break that down. Your 36-unit apartment, you own free and clear, a depression, what does that mean to you? What it means is you have different conversations with your tenants, right? Because your tenants are impacted by that.
Right.
Whether you are, your tenants are, right? Your vacancy is going to be higher, your delinquency is going to be higher. So take that into consideration. Maybe 36 isn't enough. Maybe you need 48 units, whatever, right? But it's something to think about. It might not change your lifestyle.
Well, this goes back to what we're saying, though, here, is that, let's say you have 36 units free and clear, but you live off the income of 18 of those units, and the other 18 you put away for cash reserve saving, or you live off 30 of those units, and the other 6 you just keep as complete gravy. Yep. So then if you do have, let's just say you have 36-unit complex, and you have a depression happen, and 6 of your tenants can no longer pay, and 6 out of 36, that's 30% of your 30%. Yeah. I mean, that's a pretty healthy number, and you're still keeping your same style of living. You don't need to really worry as much. And again, whether it's houses or not, too. Yep. But I really like what you just said, is that you really use a depression or recession as a way to just make better terms or better decisions, I guess. But it really shouldn't affect entrepreneurs, business owners that are taking control.
It shouldn't stop the growth that you want, whether it's massive growth or if it's a lifestyle by design.
I would say in general, this too, is that as long as you are, and anybody watching this and listening to this, is as long as you are taking control of your own personal well-being and your own financial well-being and not letting someone else dictate it to you, a recession or depression really should not matter, except the choices you make and how you choose to move forward in that.
And if you're listening to this, it's probably not you.
That's yeah. If you're listening, you're probably one of those
randomly
people.
Found this on YouTube or a podcast, which is probably very unlikely.
Right. You're probably one of those people.
You're probably one that you're gonna slightly shift your decision making during.
Yep.
And the question is, I kind of go back to the statistics. So like the recession is the lagging indicator, right? The leading indicator are things that we try to pay attention to.
Right.
I don't have a list of those right now, but the speed of the volume of market, like how fast properties sell, what they sell for, those are all very important leading indicators to a future recession.
Right.
That's how I would look
Well,
at it.
and anybody that owns houses or apartments too, one leading indicator can be how many showings you have to to get your property leased up. If you've got a lot of showings, it can mean a couple things. I mean, it could just mean you have a bad property. It could mean your rent's too high. But if your rent is in line with the rest of the market, if you know this, if your rent's in line with the rest of the market and you have a good property, you're taking more showings, then that probably means that people are getting a little more nervous and cautious. That's the leading indicator.
Yep.
Now, again, it could also mean your property's bad. It could also mean your bad location, your rent's too high. Could be many other things. It's learning to ask those questions.
I feel
and
like
dive deeper.
that's a good stat for someone that owns a lot of units instead of the people that own like 5 units.
Correct.
Right? Because once every, 2 months, you have to fill a unit if you're having turnover, right?
Well,
and then you have very, very small anecdotal data.
Well,
if you're talking to a big property manager or a big property owner and they're keeping this statistic, I know you've told a story about one of your clients that has really, really good statistics on how many showings, when they get filled, and he just knows the market so well. You can see that and lead that.
And and the reason I was saying this is this morning I was talking about a third-party vendor we are looking at utilizing as the Catalyst team here, who does track those things for his owners. He actually helps owners track those things to benchmark where they're at on their rents and their showings as well. So it's very high-minded aware for me. But I would say for anybody out there watching, if you do own a 12-plex or 5-unit or a house or a few houses or it is, and you don't know those numbers, this is why it's so important to be active investor, not passive. You need to have your team, you have your management company, have your agent, whatever it is, talk to them on a periodic basis, and make sure they're good professionals like we are. I'm going to toot our own horn, we are. So if someone calls me and says, Jared, what have you seen in the market? I can tell you because I'm watching the indicators for you guys, same as you're watching it for your clients too, or any good manager should as well. So if you are a smaller investor, you need to take at least some form of a passive or active role, reaching out to your team and asking them what they're seeing for leading indicators, not just sitting there totally passive.
Yep. And things like, your Zillow, your Realtor.com, the rents, the Facebook Marketplace, those all work, right? We look at every single multifamily property that gets put on the market. Right. Every single family rental I look at that comes up in my filter.
Right.
And one of the things that I look at, whether I have a buyer for that property or not, is what is it currently renting for?
Right.
Does it currently have a rental certificate? Like, all of those things are just part of my formula, and I don't have a document, an outline of like, this is what it is.
Right.
And it's probably bad business of me, but I have it up here of like, okay, South Side, 3-bed, 2-bath. In this part of the South Side, it's going to rent for around this to that.
Right.
Well, we just know it so well because we look at so much.
And that's where it's just also experience. I mean, I was telling someone earlier, I've been in this business now 13 years. I was talking to a buyer earlier, he was asking what I do for them as a buyer's agent. And I said, well, I've been in this business 13 years. I can just see deals and you can just see the matrix. You can just see yes or no, high rent, low rent, whatever it may be. The other thing I will say, this is why it's so important to have a team, especially when you're having shifting markets like we're potentially seeing a depression or recession coming, is we have data that is primary data. That's a huge difference between, because you go to Zillow, that's secondary data.
Yep.
That is already, again, behind the curve. Now, could it still be good data? Absolutely. It doesn't mean it's bad data, but there's a difference between reading about stats and statistics in the Wall Street Journal or the New York Stock Exchange. That's all either secondary data collected by someone else, or it's lagging, as opposed to us. When I'm having literally 50 conversations in a week, 20 to 30 of those, whatever, with actual owners, and saying, what are you feeling? What are you seeing? That is primary data right there, where no data company in the world can tell me I'm wrong when I'm hearing this straight from the client's mouth. Yep. So again, I bring this up for reasons that when you're talking about shifting markets, you need to get to primary data, not secondary data, and really figure out what's happening. And back to what I said earlier with the market, what we are seeing is we are seeing a slowing down. We are seeing some leading indicators show that properties are taking a little longer to sell, but pricing is still there. Now, does that mean it's going to be there next 6 months to a year? I don't know. Things could change a lot in 6 months to a year. I mean, we have an election coming up. We could have oil prices come up, and there's something that's going to change. But we are seeing a slowdown. It's what it is. But at the end of the day, prices are still selling.
So we did one of the agents in the office did a presentation yesterday, I think it was, and she did the median home price. And this is single families, not investment properties. Median home price for Des Moines was like, it ranged from year over year of 20% down to 17%, back up to 20% increase from 2021 each month. So like, it is still like, and that's median home price, right? We know that the pending sales are down 30%. So our closed transactions, units sold in June, will be down 30%. And there will be news articles that the market is down 30%. It does not mean the price of properties is down 30%, just the number of units sold. If you think about that number of units sold, well, if that number is down, then the prices can't go, like the rule of supply and demand, the prices cannot go down if the supply is already down, right? It just doesn't work that way, typically. So
the interesting part, as you're saying this, Darson, it just makes me think, for anybody out there watching, is, again, back to the decision-making matrix. If I'm an investor out there and I specialize in buying single-family resident houses as investments, and I know that things are starting to slow down, again, how do I change up my buying criteria? I know you mentioned before, past, we talked about how your investor clients used to have the decision-making matrix of the property was on the line on market for 5 days, 7 days.
7 to 14
then it
days,
was,
and I think you can make a pretty aggressive shot at it.
Right. So maybe now it's changing out to 10 or 12 days, whatever it is, kind of thing. But either way,
I would still, I mean, you could do that. If it's been on the market 20 days, I mean, it's overpriced. It is, absolutely is. If you take out new home builds, our days on market is still under 10.
Right. So that goes back to, again, just understanding as an investor, again, what we're seeing in the market, understanding your decision matrix. And this goes back to, again, as well, is that, as we all know, real estate, and this is something I know it's a dead horse we're going to beat, but it is hyper-local.
Yes.
I mean, if you look at even then the Des Moines market in 08, 09.
Neighborhoods.
There were certain neighborhoods that got hit very hard, and other neighborhoods that actually saw price stabilization, slight increase. And I wouldn't say they went up hella high, but they remain stable at these pricing. So let's also understand that, the axe doesn't fall evenly on that anvil. Yep. And Des Moines by itself has done a lot over the last 10 years in terms of growing as a city, as a population, and being forward thinking as a whole metro. This is not just Des Moines by itself. This is Waukee, this is Ankeny, this is all of us here.
Greater Des Moines area.
Yes, the central Iowa market, the region, the Greater Des Moines Partnership, which I believe is like something like a combination of like, it's actually, I believe it's like 11 counties, actually. It actually does include Ames, actually. Wow. I think it's 11 counties or so. I had to look at that Greater Des Moines Partnership, look it up. And they have some great stats. For any investor looking, they go to the Greater Des Moines Partnership. Great stats for our region.
The problem, yes, they do. The problem with that shit is they're trying to sell Des Moines.
Oh, absolutely.
And I have no problem with selling Des Moines. I get it. If I wasn't trying to sell Des Moines, I wouldn't have a job. But I also like to bring realistic things. But they're very good. Just take all that with a grain of salt.
Yeah. Know
their motive for putting it
I'm selling Des Moines too, and I'm not going to. And this is where, though, I will say to anybody out there watching, if you're looking to invest in Des Moines, that's great. If someone comes to me and says, I want to invest more in Cincinnati or Indianapolis or Nashville or Kansas City, great. Go the hell ahead. There's other properties other markets have other benefits too. I'm not saying that Des Moines is the greatest thing since sliced bread. What I will say is we tend to be more stable. We are that. I do think if a recession comes, it will come faster. Will it hit evenly to Des Moines as opposed to Manhattan and New York City? Hell no. I mean, there's just no ifs and buts about it. It just can't. So just bear that in mind. And again, that all ties back into, I think, decision-making matrix. It's also why I think as well we're still continuing to see property sell at almost asking prices, because people are saying, you know what, cap rates in Des Moines right now are still 6% cap rates. Sometimes we're hearing 5s, even some 7s. Now, compared to the rest of the market, that's still fairly high compared to a 3 or 4 cap in Dallas or Texas. But you know what also? We're going to probably be 6-7 cap here in a couple more years still too. I mean, you're not going to get the huge swings. We're not going to sell it for a 10 cap probably in 10 years. And they're saying we're okay with that. Yep. So just I understand how the environment is viewing Des Moines. There are reasons that we're seeing more influx of money from these institutional investors, nationals. They're saying we'll buy. I mean, we saw deals trade at 4 caps already in our market in the last couple of years. People are going, why?
And they've been good deals now.
Yeah, and people at the same point, people ask, why did you buy at a 4 cap? Well, you know what? Because we think Des Moines will continue to be a 4 cap for 5 more years, where Manhattan might drop down to a 1-point cap rate. It makes no sense. Now, I will say, this is something we should bear in mind, if we're seeing New York City investors and California investors, and not just individuals, but companies come to Des Moines, buy at 4 or 5% cap rates, we do have to ask ourselves, what happens when those 4 or 5% cap rates start springing up in New York City? Yeah. Do they pull money out of our market to go buy in their own market, where you potentially have more appreciation? So we do need to look at the underlying buying principles of those companies. Are they buying for cash flow, or are they buying for appreciation? Will they jump ship the one moment they can?
Are they Tesla or Warren Buffett?
Mm-hmm. Yeah, that's a great way to put it. Are they going to follow the trend, which is Tesla, or are they going to be the cash flow long-term investors like Warren Buffett and Berkshire Hathaway? Yep. I will say, again, talking to a lot of clients I have, I'd be curious to your thoughts. I am hearing a lot of investors get a little skittish on C-class multifamily apartments right now. We're hearing a lot more conversations about wanting to buy B or A class units from most of my buying pool. They're a little skittish that a recession or depression could hurt the C class, could hurt the working class, could be people fired. We're already hearing people start doing layoffs across the country.
I just struggle with that because, like, those are low skill. I mean, they're low skilled jobs.
Mm-hmm.
Those low skilled tenants, right? But that job isn't getting laid off,
right? Well,
like, I just don't see. I don't have any clients that I've had that, like, we want to buy only A and B, or we really want to buy A and B instead of C now. I've got a couple investors that want the A-B duplex, right, in one of the suburbs, which I completely understand. It would actually be my next purchase if I get back into the market. So I understand that. But the C-class apartments, I mean...
You know, at the end of the day, though, this goes back to everybody has their own prerogative. I mean, in some ways, you can say I like to own A and B class units because that's going to be probably the people that still have their quote-unquote A-class jobs because they can work remotely. Maybe they'll move to Des Moines because it's remote, whatever it may be. Same point, to your point, and I agree with you, Darson, when COVID hit, guess who actually was most employed? The ones that were the workers out there in the field. They had to go work. I mean, the construction workers,
it was
the essential workers.
COVID is a tough one because you had your high levels where people work from home.
I get that, yeah. And it's a double-edged sword. I mean, there are some companies who say we can offshore this, and that's white collar, we can offshore, or it's, hey, we can replace it with technology. Either way.
The interesting thing about Des Moines, so we'll wrap this up by let's do a big picture of, like, jobs, careers in Des Moines. Mm-hmm. You have insurance.
Yep.
You have ag.
Yep.
Or ag related.
Yep.
Which is still very insurance. Financial, and if you consider financial banking.
Right.
Also, right? What others?
I think government's got to be the big one too.
But every city has government.
Yeah,
right?
But we're the state capital, and we do have the state Congress here, which will continue to affect help us.
Right.
So we do have that going for us. Obviously, we're going to have still the medical. Obviously, with everybody,
we have 3 hospitals.
Everybody has that.
Unity Point, Mercy.
Yep. Everybody has that.
So, like, I mean, in those industries, which is why 08-09 Des Moines wasn't hit that hard. They don't. Well, and again,
this is where I'm going to look more again as you hold up big picture. I'm going to kind of pull out more too. This is why I do a lot of stuff across the state. I'm selling deals right now in Davenport and Cedar Rapids and Iowa City. Iowa City has the University of Iowa. It's a major medical hospital, not going anywhere anytime soon. Cedar Rapids, Cargill, manufacturing, blue collar workers.
But those cities are much more blue collar.
Yes.
And have manufacturing, like...
It's very different.
Very, very different.
But then Davenport-Bettendorf is growing because of Illinois. Yep. So each city, that's why I said too, is like each city has its own little nuance between Iowa. But you look at our 3 major cities for the most part. Omaha is separate. Yeah. Waterloo could be up there in the 4th or 5th. But the 3 major metropolitan areas, Des Moines, white collar, Cedar Rapids, Iowa City corridor, and the Davenport-Bettendorf, those 3 major populations, they're all growing.
Yeah.
And they all have benefits in different
formats.
I mean, one is growing because Illinois is doing ass backwards politics, and who they are. Cedar Rapids is that blue collar job, and it's along 380, and then Des Moines is the white collar workers. And at the end of the day, they're all growing. So why Iowa is still a great place to invest is because if you're investing in those 3 locations, for the most part, you're continuing to see growth.
Yeah, and I'm going to take even a bigger picture of that. It's why I think a lot of people overlook the place that they're currently living, because and most of my clients that are out of state are in the Denver, the New York, the California, like the very high price markets. So it is tough to get anything close to what you're seeing in Des Moines. But when I have someone call me from Omaha and say I want to invest in Des Moines, my first answer is why. Mm-hmm. Invest in your backyard if you're in a market that isn't incredibly insanely overpriced, right? Like, I'm the dumb agent that says, stay in your market, don't come here. And not because I don't want more competition, because I think there's a house on every corner, but because you're just trying to find an excuse of why not to invest. So you're trying to pick a market.
I'm sorry. No, I tend to agree. And the only thing I can say about that is, and again, like the Omaha's a terrible example, Minneapolis as well, Kansas City, because those are all like our markets. No, but I agree with you. If you're in a similar mid-tier market, then stay in your own freaking market. Now, it's different if you're in San Francisco and you're trying to buy a fourplex that's going to cost you $4 million, and you cannot buy it personally. Now, with that being said, I will say for anybody in those markets, San Francisco, the LA, the potentially Austin, Texas, Miami, in the New York markets, what I would say for those guys is you need to get really good at syndicating and raising money to do deals in those markets, because you can find deals in your own market if you're good at raising money syndication. The problem with that is is if you're a new investor, no one wants to give you fucking money. So that's where I say come to Iowa, do a couple deals, learn how deals work, get your feet wet, learn how to syndicate, and then take those same principles and practices back to your own market and go syndicate deals in San Francisco, Miami, whatever it may be, Washington, D.C., New York City. Because again, those same deals are happening across the country no matter where you're at. It's just that buying a $4 million fourplex in San Francisco is different than buying a $4 million apartment complex in Des Moines. Here you can learn how to syndicate, which I will say, makes me think of another point. That's also why sellers, be careful. We do have a lot of new syndicators in our market because they are trying to learn how to syndicate, and they're throwing out offers all over our market because they're trying to figure out their system. So sellers, make sure you are very heavily qualifying your buyers if you're going direct, or if you're an agent involved like us, make sure you're qualifying because we have a lot of new syndication groups in our market who are trying to learn their feet wet so they can take it back to their own markets.
Yes. Okay, we'll wrap this up.
Yeah.
I agree. So there's a lot of market talk, a lot of just about Des Moines talk about Iowa. So appreciate it. If you have any questions or want to get on one of our, contact or mailing list, my information is below. I send out an email every Friday and have a YouTube channel to just educate and make you a smarter investor, whether it's in Des Moines or in your own market. I don't care. I mean, if it's in Des Moines, hopefully you'll reach out and we'll at least have a conversation. But if not, no big deal. Appreciate you watching, and I'll let Jared tell you where to find his stuff.
Yeah, for us, you can come to catalystteam.com, KATALYST. You can also Google me. We have social media. We're doing more on. We have our own YouTube channel as well. And as I always say, we're just here to offer a little transparency on the market because at the end of the day, real estate investing, especially commercial, is very opaque, and we're just trying to offer a little transparency on what we're seeing and everything.
Cool.
So
appreciate it. Thanks for watching.
See you guys next time.
See ya.
Bye.